Mr. Lewis, any changes or additions to the agenda tonight?
There are no changes, Mr. Chairman.
Okay. No special actions. And I guess we'll go into the 2018 pension performance report. Mr. Kalson.
I was told 10 minutes and no more, or I'm history, so
Well,
I'm working on
we
it.
have gentlemen with guns in the audience, so.
Sage advice.
Right. Thank you for having me, and good evening to you. There's no getting around how bad the fourth quarter was, not only for your funds, but for the markets in general and for public pension plans around the country. But lo and behold, the market made a V, if you can just picture the letter V. And if you look at your pass out there, the one that says Q4 2018 and year-to-date 2019 returns, so the plans were somewhere between minus 9.3 and 9.5 in the fourth quarter, you know, at red ink for sure. But if you go to the right-hand column, it's right back. And this is as of March 11th. The last 2 trading days, I'm sure, take these numbers up to 10% or more. So, I think we were very lucky that happened. Certainly the market could have continued down. And there are a lot of pluses, and the most important of those are that the Federal Reserve stopped raising interest rates. Investors like that. There's progress of a sort between China and us as far as trade negotiations. That's a plus. And job growth was tremendous, at least in January, and that was a plus. But there are negatives out there. Brexit. Corporate earnings can't continue to grow the way they've been growing, so they're going to slow down. That doesn't mean that there's something wrong with corporate America. It's just the earnings were just so high they can't be sustained. The rate of growth has to slow down. And there's a lot of uncertainty in Washington. There are populist governments all around the world. So it's sort of like, you know, us first and the rest of you all second. And that's not good. If global trade is a plus, that's a minus. So I think we were lucky. I was on a Mack 7 plane last Thursday, so I guess I'm lucky too. Markets have really helped the funds more than the individual managers that you have. It's just the momentum of the market since the bottom in 2009. And I came to the realization that I don't think it can continue, but people that know a lot more than I do, you know, people like Goldman Sachs and Vanguard, those would be names that we all know, they're saying that the future, at least for the next 10 years, is not going to be nearly as rosy in terms of the cumulative return, and in the meantime there's going to be a lot of volatility along the way. Your fund, the target, is 75% equity, 25% bonds. That's very high. That's not bad, that's not wrong. You're underfunded, and that's the way over time to get to full funding. But I believe that that's high. So I polled all the public plans that we consult with, and there are 58 such plans, and you are the highest among those. Again, not bad or wrong, and it's served you well. But I'm recommending, and that's the next piece of paper, I'm recommending a change. What I'm recommending is, instead of having the target 75%, and right now, the plans have come back to the point where they're 73, 74%. actual. I'm recommending that we scale back to 68%. Not necessarily tomorrow morning, but reasonably soon. So if we do that, it's a hedge. What it's saying is that if the market continues as volatile as it has been, and the market tumbles 10% or something, you're going to fall, but you won't fall quite as much as you have been falling. The downside of that is if the market continues to do for the next 10 years what it has been doing for the past 10 years, you won't earn as much, okay? I think the hedge is appropriate, I think it's prudent, and that's why I'm recommending it. Now, if the market goes up, let's say it goes from 68 to 72 over a year and a half, I'm saying around at that point, doesn't have to be precise, that you scale back to 68% again. Let it ride up and then scale back. If the market tumbles, let's say it tumbles to 64%, then I'm saying, you know what, it's not going to go to zero. You want to be invested. Let's scale back up to 68%. So the range would be between 64% and 72%. And I don't want to be overly precise because it's real hard to pick the exact day that that happens. But reasonably soon after it would hit 72, reasonably soon after it would fall to 64, I'm recommending that you rebalance to 68. Now, if you were to agree to that, how would we accomplish it? Very straightforward, how would we accomplish it? You have a fund that is sort of like a grandfather fund in there called Longview. It's a equity index fund. It's been there for my time, and we have bled that account down when we needed funds. There's very little left, so I'm saying take enough from that fund goes away, but that will still leave the majority of assets that you need to transfer from equity to bonds. And I'm saying take that from your mid-cap value fund. The name of it is Ceredus, C-E-R-E-D-U-S. Actually has another name to go with it. That fund has about 15% of the assets. It'll still have more than 10% of the assets when we take that money from them. There's nothing wrong with that fund. In fact, it lost less in the fourth quarter than its index did, and cumulatively it's done fine. And you know, I'd like to see it stay in, but it's a source of funds, I think, for this purpose. So take those proceeds, put them into the bond fund that you have, which is the PIMCO bond fund, which is performing okay, and you've added to the hedge should the market fall.
Thank you, Grant. I would like to echo that Grant and Dahab have done a fantastic job navigating a very difficult 2018 as far as the markets and the equities go. For us to be back basically where we started 2018 with the way things have been is truly remarkable. So Grant and I had a long discussion. I guess I'll turn it over to the board with any questions that you may have.
Any questions?
I have a question. You mentioned that the funds, this was underfunded. I'm not an economist. Can you explain that and the situation a little bit better?
I can easily duck that question because I'm not an actuary, but in plain English, and that's all I know as far as actuarial stuff, you have a stream of liabilities going out almost forever for your employees, okay? And the actuary brings that back by a certain discount rate to a current value. And you compare that to the market value of your fund. And there's a smoothing that goes on. So it isn't just end of 2018 market value. It's a smoothing over some years. But like most public plans, your current market value is less than that stream of assets brought back to the present value.
Do you have a number for that?
I don't. I don't know. I think the funding is in the low to mid 80%, but I'm not certain what that funding level is.
The state issues that report every other year about how much our the percentage of funding that our pension assets are at.
And when was that last time?
I believe it was 2017, 16, 17,
You said every year,
every other year.
every other year, okay.
And to the extent that the plan is less than 100% funded, then the township pays X dollars into the plan to help right that ship, like you would pay off a mortgage.
But you said our plan was near the top of the 58 that you manage in terms of...
In terms of the equity exposure that you have in the plan, it is at the high end, and I at the expense of just boring you to tears. It's not bad, it's not wrong, it's just where you've been, okay? That has really worked for you because the markets for the last 10 years have been irregularly up, and the more you have in equity, the more up you go. And so it's been very beneficial. I'm scared to death right now. I want to step it down.
I just wanted to verify something. Although you're saying our fund in the fourth quarter of 2018 was down, 9.5% more or less. I got some numbers from the internet, could be fake, but it said generally the Dow Jones in the fourth quarter was down over 11%. So we're not as bad as perhaps somebody who just invested in the Dow Jones.
No, thank you for that. I just didn't want to color it nicer for the sake of coloring it nicer. Yes, we had some managers that did less negatively than their index did, than their benchmark did, okay? Some did worse, some did worse. Like you have a fund, Fidelity Blue Chip Growth Fund. I mean, Amazon, Tesla, you name it, Facebook, all those names, and they plunged in the fourth quarter, and then you have to reverse themselves. And that fund, through the 11th, is ahead of its benchmark, and it's like 13.8%. Don't hold me to the tenths, but so it's more than this plus 10%. Yeah, so some of your funds have done.
Just saying, Facebook was down today, so
Okay.
I don't know how that affects the stock.
So, did I make myself clear on your question?
Yes, I think so.
Okay.
Kyle? Dennis? Sure, good.
Real quick, I think I heard you say that there's no clear point in time that you would do the rebalancing, but sooner than later.
Sooner or later, I would like, in other words, I'm on purpose being a little flexible here, rather than saying on March 21st, let's get it done, let's call the custodian. If it could be done by quarter end or shortly thereafter, that's what I'm recommending. And I would work, if you agree, I would work with Micah and his people.
Now, Grant, you're anticipating a dismal year ahead, is that correct? I mean, from what you're telling us?
Yeah, yes and no.
Okay. Well, here's my question.
Yeah.
And I understand you said that things are screwy in Washington, but there is an election year coming up, and economists are going to want the economy to get better because it makes everyone look better, whoever.
Sure.
Okay.
Sure.
Now, why would we drop it drastically to 68% when you have that range of 72 to 64? Why wouldn't we go maybe to 72, hedging that it will be a rebound in coming back? Or if we're doing so good at 75, why don't we keep it there for a while to see what's going to happen? You said there's no time. It's basically a crapshoot of when we're supposed to make this change from what you're telling us. But it looks like we rebounded drastically on the positive side at the positioning that we're at now.
If you go down to 68%, you're hedging your bets. You're in effect putting some cash away, pushing real hard. The assumption is things will not be as rosy in terms of double-digit equity returns on average for the next 10 years. And smart people are saying that. Forecasts can be dead wrong, but Goldman Sachs is saying that, Vanguard is saying that, several other people are saying that. So they're also saying whatever the return is going to be, it's going to be a volatile ride. So you have two things happening, okay? The expectation of lower returns and the expectation of more volatility. And we had some of that volatility in the fourth quarter. We've even had volatility on the upside in the first quarter of this year. So I'm saying park a little bit. And if you wind up at 68% as your target, instead of what you have now, instead of the 72 that I think you're suggesting, and there's nothing wrong with what you're suggesting, you're still at the very high end among public pension plans. You're out there among public pension plans. At 68, you're out there. So I'm saying I may come back here, if you'll have me, 6 months from now and say, you know what? I'm recommending a lower still.